Hello everyone. Today I'm going to present chapter 3, and chapter 3 is about business income and expenses, and this is the first part. So this chapter is this topic is mainly divided into two chapters. So both this chapter in the context of the other chapters. So we in chapter 1 we started with the individual income tax return. Okay, and in chapter 2 we mainly presented gross income and exclusion, so which is mainly what income included and what income that is excluded. So today we are mainly looking at chapter 3, which is business income and expenses. And this mainly this topic, as I said before, it is mainly over two chapter 3 and chapter 4. So, what are the learning objectives for this chapter? So, the first objective is complete a basic Schedule C, and then understand the tax treatment of inventories and cost of goods sold. So, remember here, inventories and cost of goods sold is mainly in ACC T201 and ACCT 301. So we already studied this topic before. So we'll see similar treatment to financial reporting and identify the requirement for deducting transportation, travel, meals, entertainment, and business education. This mainly the expenses that the company incur, and it need to be we need to see how it is treated from taxation point of view, and then determine deduction for dues, subscription, business gift, and the clothing and uniform. This is merely another set of business expenses. Identify the requirement for claiming bad debt deduction, home office net operating losses, and hobbies losses. Then we started the first topic here, which is defining trade or business and test for deductibility. So what is meant by business or trade? Because the chapter here is about business income and expenses. So what is meant by business? Okay, so we're starting here with the definition of trade or business and the test for deductibility. Deductibility here, what are the expenses that can be deducted or acceptable from taxation point of view. A trade or business is not specifically defined in the Internal Revenue Code. Internal Revenue Code is a tax law in the USA. But it's generally an activity conducted for profit. So any activity conducted to gain a profit, so this may be considered a trade or business. Okay, so whether it is organized as a firm or not, so this is mainly a different issue. For a deduction to generally be considered deductible for a trade or business, it must be ordinary and necessary. Okay, so this is a condition for deducting any expenses related to the business or a trade, and it should be ordinary and necessary, which is mainly required for the business to be conducted, have a legitimate business reason or purpose. So it should be achieving a specific purpose for the business. Okay, it is not personal, so it is business related. Be reasonable in the light of the fees that are generated as a result of the expense. So this mainly this test about reasonableness, so is linked to the revenue generated by spending these expenses. So which means that we shouldn't spend expenses more than the income that should be generated from spending these expenses. So at least we should generate as revenue the same amount or higher than the expenses spent to generate the revenue. So look at now a related question to this topic. So which of the following is not a test for the deductibility of a business expense? A. Ordinary and necessary test, expectation of profit test, reasonableness test, business purpose test. So remember that we have these three conditions. So be ordinary and necessary, have a legitimate business purpose, be reasonable. So this is the three conditions for deductibility. So the only one that is not a test for deductibility is expectation of profit test. So the answer here is B. So moving to the next topic. So we have Schedule C versus Schedule CEZ. So we have these two schedules. So Schedule C, this is mainly taxpayer who operates business as a sole proprietorship must file Schedule C. So if the taxpayer is a sole trader, so in this case, he or she is required to file Schedule C, which is the long form, or Schedule CEZ, which is the short form. So we have these two forms. Okay, so let's see these two schedules. So we started here with Schedule C. So for Schedule C, so Schedule C is mainly called profit or loss from business. And it has different sections. So the first part is mainly about personal details, a name of perpetuator, principal business or profession, including product or service, business name, business address, accounting method, whether it is cash basis or accrual basis, and then did you materially participate in the operation of this business, so which is mainly managing the business. If you started or acquired this business during 2017, so which is mainly the starting date of the business, do you make any payment in 2017 that would require you to file forms 1099? If yes, did you or will you file required form 1099? And then we have the first part about income. This form is very similar to the income statement. Okay, so it has the first part about income, gross receipt or sales, return or and allowance, and then cost of goods sold, and then we got gross profit and other income, including federal and state gasoline or fuel tax credit or refund, and then we get gross income. So this is the first section. The second section about expenses. So we have different categories of expenses: advertising, car and truck expenses, commission and fees. So this mainly the several type of expenses, and then we got the total expenses. Okay, and then the difference here between gross income and expenses will be tentative profit or loss. Okay, and then we have other expenses here, which is mainly here expenses for business use of your home. So which means that if the taxpayer use their home as address for the business, and then net profit or loss. Okay, so this is mainly similar to an income statement. Okay, and we have the third part is about cost of goods sold. So this is mainly about the inventory used by the business, which method is mainly used, cost or lower or of cost or market or other method. And then we got a formula here to work out the inventory at the end of the year and also the cost of goods sold. So we have beginning inventory purchase, okay, and the other cost, and then we get the inventory at the end of the year and then cost of goods sold. We have the fourth section here is about information about vehicle. So it is mainly if the taxpayer use their car or their car in running the business. So we need the information about different uses of the car, and then the final part is about other expenses, if there are any other expenses. So this is mainly part 3, 4, and 5. This may give additional information about some items included here in the income statement. Okay. So this is mainly the first schedule, which is schedule C. Let's see the schedule CEZ, which is mainly the short form. Okay, so there are some conditions required to use this specific form, and this condition here is given here in the general information. You may use schedule CEZ instead of schedule C only if you have a business expense of 5,000 or less, use the cash method of accounting, didn't have an inventory at any time during the year, didn't have a net loss from your business, have only one business as either a sole proprietor, a qualified joint venture, or a statutory employee, and you have no employees during the year. Don't deduct expenses for business use of your home. Don't have prior year unallocated passive activity losses from this business, and are not required to file Form 4562 depreciation and amortization, which means that you don't have accrual basis, because the requirement here is to use a cash basis. And we have some other information here. This is mainly personal information about personal details, business principal, business or profession, business name, business address, city, town, or postal office. Okay, and figure your net profit. So we have just one line, and we don't have detailed information about the revenue or the income. We have gross receipts and caution if this income was reported to you on Form W2 and the statutory employees box. On that form was checked. See statutory employees in the instruction for Schedule C line 1 and check here. And then we have total expenses, so we don't give all the details about the expenses. It's just one line. And then the net income, which is the difference between gross receipts and total expenses. And then we have part 3 is the same, is about information on your vehicle. This means the same as Schedule C. Okay, and the instruction here to fill in this form. Okay. So this is mainly the two main form, which is Schedule C versus Schedule C EZ. Okay, and we saw the different section here: income, expenses, cost of goods sold, vehicle, and other expenses. And we saw also the condition that are required to use Schedule C or CEZ. So moving to another question, which is number 2. In the current year, Mary started a profitable housekeeping business as a sole proprietor. She has 10 housekeepers working for her, and spend her time selling their service and coordinating her employees' time. Mary made $50,000 in her first year of operation. In addition to filing a Schedule C to report her business earning, Mary must also file. Okay, so this is mainly here a case that is related to self-employed. Okay, and for self-employment, so we have some specific rules. Okay, so taxpayer with net earning of 400 or more required to pay self-employment tax. File Schedule SE with Form 1040. Okay, so in addition to Form 1040, which is Schedule C, so Form 1040 Schedule C. So in addition to this form, so the taxpayer is also required to file Schedule SE, okay, to mainly pay for the self-employment tax. Okay, and self-employment tax equal social security tax, which is 12.4% on the first $127 to $100 plus Medicare tax, which is 2.9% of all net earnings. Okay, and taxpayer get a deduction for adjusted gross income equal to half of the self-employment tax. So this is mainly deduction which is half of the self-employment tax. So the question here is asking about in addition to filing Schedule C to report her business earning, Mary must also file. So it is Schedule SE, which related to self-employment tax. So SE is self-employment because Mary is mainly working as self-employed. Okay, so this is mainly the second question. So the answer here is D. Moving to question 3 in multiple choice questions. So Daniel is a self-employed consultant. Until this year, he was always an employee. He came to discuss his new business with you. As his tax accountant, you should discuss setting up a good record-keeping system for his new business. Discuss the substantiation requirement for meals and entertainment. Discuss self-employment tax as well as the income tax on business earning in order to help Daniel estimate what he might owe in taxes for the year. Discuss the rules for deducting automobile expenses. Discuss all of the above. So as consultant, so you merely advising your client on all these aspects. So in this case, so the answer should be discuss all of the above. Okay. So moving now to another related issue. It is about gambling winnings. So gambling income is not reported on a Schedule C unless the taxpayer is a professional gambler. So this merely is not a business. It is a hobby. So but if it is turned to be a professional gambler, so it will become a business and it should be reported on Schedule C. So we have here net casual gambling winnings are reported as other income on Form 1040. So on Form 1040, so it is a part of other income. So it is not reported under Schedule C, but it is reported as part of Form 1040 as other income. Gambling loss are deductible as miscellaneous itemized deduction on Schedule A, and these losses are limited to gambling winnings. So this is mainly the losses are limited to gambling winnings. This is mainly related to this condition about the reasonableness, which is mainly the fees that are generated as a result of the expenses. So it is mainly the income is limited. Sorry, the losses are limited to the income that is generated. So this mainly to make sure this test of reasonableness is mainly met. Okay. Moving to the inventory. And for inventory, this is mainly similar to what we have in financial reporting, okay, which is ACCT 201 and ACCT 301. So we mainly using similar principles. Okay, so we have cost of goods sold is a significant deduction for many retail business, and cost of beginning ending inventory crucial to the calculation of deduction, which is mainly cost of goods sold. We have different methods here to apply. We have LIFO and FIFO. This is mainly most commonly used method for of costing inventory. Okay, so we already know about FIFO and LIFO before. If LIFO is used for tax, it must also be used for financial purposes. This condition here from tax authorities. So if the company chooses to use LIFO for tax, so it should be used also when the company prepare their financial statements. So Form 920 used to elect LIFO. So when the company choose to use LIFO, they have to use or inform the tax authority using the Form 920. Okay. So remember these equations here about the inventory. Okay. So cost of inventory or cost of goods sold can be the largest expense of a taxpayer and the inventory cost here. So we mainly use this equation to work out. So we have beginning inventory plus purchase. This is mainly called cost of goods available for sale. Okay. If we exclude from the cost of goods available for sale the ending inventory, so we mainly calculating here cost of goods sold. Okay. And FIFO LIFO again, and method doesn't have to represent the way your business operate. It is cost allocation tool, so it is just for allocating the cost of inventory purchase between the items that is mainly sold and the items that are still in the warehouse. Once the taxpayer make the election, so it is mainly FIFO or LIFO, so no change can be made without IRS consent, okay, which is the tax authority in the USA. Okay. So we have some questions on this specific issue. So we have some question related to this issue. So we have question multiple choice 4 and 5. So which of the following formulas represents the proper method of calculating cost of goods sold? So remember, cost of goods sold is mainly calculated using this equation: beginning inventory plus purchase minus end inventory. This is mainly the cost of goods sold. So the answer here is D, which is beginning inventory plus purchase minus ending inventory. So this merely cost of good sold. Okay. So moving to question number 5. If a taxpayer has beginning inventory 25,000, purchase 175,000, and in the inventory 45,000, what is the amount of cost of goods sold? So this again using the simple equation to work out the cost of goods sold. So cost of goods sold equal beginning inventory, which is 25,000. So this is the beginning inventory plus purchase, which is 175,000, and excluding the ending inventory, which is 45,000. So this will give us the cost of goods sold. So which is 155,000. So and this means the answer here is A. So the answer is A. Okay, which is 155,000. So we have also some related problems. Okay, so the related problems that we have. So we have problem 3 and 4 and 5. So moving to the problems. So this is problem 3. Okay. And this problem here is mainly on page 37. Lawrence owns a small candy store that sells one type of candy. His beginning inventory of candy was made up of 10,000 boxes, costing 1.5 per box, which is $15,000, and he made the following purchase of candy during the year. We have March 1st, August 15, November 20. We have the number of boxes and the cost per box and the total amount at the end of the year. Lawrence inventory consists of 15,000 boxes. This is a number of units in ending inventory. Calculate Lawrence ending inventory and cost of goods sold using FIFO method. So we need the ending inventory and cost of goods sold, and also the same requirements but using LIFO. So this is mainly about applying both methods, FIFO and LIFO. Okay. So moving now to problem 3. So for problem 3, we need the information first about number of units. Okay, and then we need the cost per unit. And then total cost. We need also another column here, and this column about the date. So we have first beginning inventory. So it's beginning inventory. So the number of units is 10,000, and the cost per unit is 1.5 per box, and the total here is 15,000. And then we have a number of purchase. So we have March 1st. Number of units is 10,000. And cost per unit is 1.6. And then we have August. 15. Number of units is 20,000, and the cost per unit 1.7. So the total cost here is 34,000. And then we have November 20. So the number of units is 10,000, and the cost per unit is 1.8. And then the total cost here is 18,000. So this is mainly the inventory, beginning inventory, and the purchase during the year. So from this information, we calculate the goods available for sale as units and cost. Just adding up the number of units. Okay, and then we need to split these units, okay, between cost of goods sold and ending inventory. So we need to apply the two methods, which is FIFO and LIFO. So we're starting with FIFO, which is first in, first out. First in, first out. Okay. So first in, it means first purchase, first sold. First purchase, first sold. So for cost of goods sold, it will be calculated here from the beginning. First in, first purchase, first sold. Okay. So we need to identify how many units in the ending inventory and how many units sold. So this is already given here in the question. So we have at the end of the year, Larson's in inventory consists of 15,000 boxes of candy. So this is merely the ending inventory. So the number of units in the ending inventory is 15,000. So this means that the number of units sold is merely the difference here between the units available for sale, which is 50,000, minus the ending inventory, which is 15,000. Okay, so which is 35,000. So 35,000 sold and 15,000 is still in the warehouse. So we need to determine the cost of these items here according to FIFO and LIFO, which is last in, first out. So starting with first in, first out. So we have 35,000 units sold. Okay, so we need to determine the cost of this unit. So we started here from the beginning. So it is first in, first purchase, first sold. So starting from beginning inventory. So we have 10,000, and so this is many units, and cost per unit. And then total cost. So for cost of goods sold, this is cost of goods sold. Okay. So starting from beginning, so we have 10,000, and the 10,000 here, the cost per unit here is 1.5. Okay, and then we have another 10,000, which is mainly from March 1st. Okay, and the cost for per unit is 1.5. So remember here we need 35,000 units as cost of goods sold. So we have 10, and this 20. We still need 15. So the 15,000 remaining will come from August 15. So we have 15,000, and this 15,000 from August 15, which at a price of 1.7. So this is mainly 1.6. And then we have 1.7. Okay, so this is mainly the total here is 35,000. This is the total. So we need the cost of these items. So just multiply the units by the cost per unit. Then you get the total cost. And then this total here is 56,500. So this mainly the cost of goods sold according to FIFO. So this is mainly 56,500. Okay, so we need now the cost of inventory. So the cost of inventory can be calculated as remaining balance. So we have the total cost here of goods available for sale, which is 83,000, and then excludes the cost of goods sold, which is 56,500. So then we get the cost of inventory, ending inventory, which is 83,000 minus the 56,500. So which is 26,500. So this mainly if the company apply first in, first out. So we move now to LIFO, which is last in, first out, which is again last purchase, first sold, last purchase, first sold. Okay, so again we working out cost of goods sold, which is 35,000 units, and then we having the same titles, units, cost or per unit, and the total. So for LIFO, we start from the end, which is means the last purchase. So last in, first out. So we have total number of units is 35,000. So we're starting here from the end. So the end is November 20, from November 20. So we have 10,000. Okay. And the cost per unit here is 1.8. Okay. Then we have the next one is 20,000. Okay, this mainly from August 15, and the cost per unit is 1.7. So the total now is 30. So we need 35,000. Okay. So we still need 5,000, and 5,000 will come from March 1st. So this mainly 5,000. And the cost per unit for March 1st is 1.6. And we'll work out the total cost. Just multiply the units by the cost per unit. And then we get the total. So total number of units is 35. And the total cost of goods sold is 60,000. So this mainly the cost that we need to calculate. So cost of goods sold is 60,000 according to LIFO, and then the difference here between the cost of goods available, which is 83,000, minus 60,000, which is the cost of goods sold. This will give us the cost of ending inventory. Which is 23,000, and this may be the solution of problem 3, which is merely requiring ending inventory and cost of goods sold for FIFO, and ending inventory and cost of goods sold for LIFO. Okay, so we'll move now to problem number 4. Kevin owns a retail store, and during the current year he purchased 610,000 worth of inventory. Kevin's beginning inventory was 67,000, and his ending inventory is 77,200. During the year, Kevin withdrew 1,780 in inventory for his personal use. Use part 3 of Schedule C below to calculate Kevin's cost of goods sold for the year. And this is mainly the part that we need to fill in, which is part 3. Okay, so returning back to the information that we have for this part. Okay, so we have this is mainly Schedule C, and this is the part. So we need inventory at beginning of the year. So the method that we use is the cost. Okay, was there any change in term and quantity, cost, and valuation between opening and costing? So the answer here is no. Okay, because we may be using the same method, which is the cost. Then we get the inventory at beginning of the year, and the inventory at beginning of the year is given here as 67,000. So this is really 67,000. So we have purchase less cost of items with draw for personal use. Okay, so we have purchase. So the purchase here is 610,000. So this is a purchase, and the item here withdraw for personal use is 1,780. So we're calculating here the purchase excluding the item withdraw for personal use. So we have 10,000. So 610,000, and then take away the 1,780. So the remaining amount is 608,220, and this is merely the amount that we will use in the form. So which is 608,220. Cost of labor, so we don't have cost of labor. Material we don't have, or other costs also we don't have. And then add lines 35 through 39, 35 through 39. So we have only 35 and 36, so we'll add them up. Okay, so this means the cost of purchase excluding the items for personal use and plus beginning inventory, which is 67,000. So the total here is 675,220, and this will be in line 40. So 675,220, and then we need the inventory at the end of the year, and the inventory at the end of the year is 77,200. 77,200. So this will be minus 77,200. So from this item, from this total, which is the cost of goods available, minus 77,200. So we have now 598,020. So this is mainly the cost of goods sold. So this is the cost of goods sold. So 598,020. So, and this is mainly the answer to this problem, which is problem 4. So we'll ignore problem 5, which is go to the IRS website and find the most recent IRS publication. So we'll ignore this question. So we'll return back to the slides. So we're now looking at transportation. So we have for transportation here, it can be by aeroplane, rail, or bus, okay, or car, which is mainly called automobile. So we have certain transportation expense for business purpose are deductible by taxpayer. Okay, taxpayer doesn't have to be away from tax home to get transportation deduction. So there are some cases here for transportation deduction even within the tax home. So commuting this mainly when the taxpayer go to the work every day is never deductible. Okay, so which is mainly considered as personal transportation. So there are some exceptions here. Traveling between home and work location outside the metro area where taxpayer has a regular place of business. Traveling between home and temporary work when taxpayer has regular place of business, and travel when taxpayer principal place of business is home. Okay, plus can deduct additional cost of healing tool and instruments. Cost here of aeroplane, rail, bus and auto, actual or standard, potentially deductible. Okay, so the taxpayer here may choose between actual method or a standard method for deducting the cost of automobile. So may choose a standard mileage deduction, and if the taxpayer choose a standard method for deducting the cost of transportation, so we have a rate here. This is the standard rate per mile, so it is 0.535 dollar per mile plus business portion of parking, tool and personal property taxes plus auto loan interest if self-employed. So this is mainly the rule for standard deduction. So when the taxpayer can use the standard mileage deduction. So there are some conditions here. The taxpayer must own or lease car, not own fleet using 5 or more autos simultaneously, not have taken depreciation other than straight line. So the method that should be used to work out depreciation for the cars is mainly straight line method. Not have taken section 179 depreciation on auto, which is mainly this section about accelerated depreciation. We'll see this later on in the chapter related to depreciation. When the taxpayer should use the actual method. So If it choose actual method, cannot change to standard method. So this mainly is a rule from taxation point of view. So if it choose actual method, so the taxpayer cannot return back to the standard method. So if it choose standard method, may it change to the actual, but then must use a straight line depreciation for vehicles. So if the taxpayer here it choose to change choose the standard method as starting point, so he or she can change to actual, but once they change they have to use a straight line method to work out depreciation. So this is really another restriction here. So must keep adequate cost record. So because actual method need a record to mainly determine the actual cost. To calculate deduction, multiply actual expenses by business use percentage. So business use percentage, so this mainly it means how many miles mainly used in the business. So how many miles the car are used in the business. So business miles over the total miles that the car mainly is spent. Actual expenses here, this is mainly example of actual expenses for the car or for the vehicle. Includes the business portion of gas, oil, repair and maintenance, depreciation, personal property taxes, interest on car if self-employed. Business-related parking tools fully deductible, not multiplied by business use percentage. So this mainly excluded here from the use of business use percentage here, which is business-related parking tool. Reporting here, taxpayer other than self-employed should report on Form 2106, which carries to Schedule A. So this mainly the information about the transportation. So we'll see now some question. So we have multiple choice questions. So we have question number 6. So for question 6, so we have which of the following taxpayer may use the standard mileage method of calculating transportation cost? A driver who owns a fleet of 6 cars. So remember the condition here for using this method. So on or lease car, not on fleet of using 5 or more autos, not have taken depreciation other than straight line, and not have taken section 179 depreciation, which is mainly about the accelerated depreciation. So you see here a driver who own a fleet of 6 cars, so the maximum is 5. Taxpayer who use accelerated depreciation, this also which is section 179, this is mainly not allowed. A business executive who claimed bonus depreciation in the first year she used the car, this is also about accelerated depreciation. So we have an attorney who used his Porsche for calling on client. So this is mainly the answer here. So it doesn't matter the type of car. So it is a car that is mainly used by the taxpayer in the running the business. So which is mainly own or lease a car. Okay. So this is the answer here, which is D. We have Heather drives her minivan 953 miles for business purpose. In 2017, she elected to use the standard mileage rate for her auto expense deduction. Her deduction will be, so we mainly using the standard rate. Okay, and remember here the standard rate is 0.535 per mile. Okay, so we'll multiply this by the number of mileage. Okay, so the rate is 0.535 multiplied by 953 miles, and this many for business. Okay, so we'll get now the deduction. So which is 509.8, so which is roughly rounded up to 510. Okay, and the answer here is A. This is merely for a multiple choice 7. Okay, so we'll move now to some problems related to this learning objective. Okay, so we'll see now problem 6 for transportation. We have Teresa is a civil engineer who uses her automobile for business. Teresa drove her automobile a total of 11,965 miles during 2017, of which 80% was business mileage. The actual cost of gasoline, oil, depreciation, repair, and insurance for the year was 6,440. So the first requirement here, how much is Teresa transportation deduction based on the standard mileage method? Okay, so remember here the rate for standard mileage, it is 0.53 per mile. Okay, so this is merely problem 6, and we have A. So we merely multiply the standard rate, which is 0.535, times by the business mileage. So we have the total mileage is 11,965. So this merely for the total, which include business and personal, multiplied by 80%, which is business related expenses, and then we'll get the amount of transportation cost business related. So which is 5,121. Okay, so this is merely number A, which is the standard method. How much is Teresa transportation deduction based on actual method? So this merely the actual method. Okay, so for actual method, so we have the actual cost here, which is 6,440. So this merely the total expenses, and this is merely for both personal and business related. So this will be multiplied by 80%, which is business related. So based on this percentage, so we can get the actual transportation cost. So the actual transportation cost is 5,152. Question number C. Which method should Teresa use to calculate her transportation deduction? So this mainly comparing here between the amount of deduction according to standard method and the amount of deduction according to the actual method. So you see here the actual method produce the higher amount, which is 5,152. So it will be advantage here to use the actual method to determine the deduction, transportation deduction. So based on this information, the actual expenses are preferable. Okay. We see here Teresa should use this method. Okay. To determine her transportation deduction, and Teresa is eligible to use either the standard mileage if used previously, or exchange to the actual method this year. So this mainly the method here that should be used, so which is the actual expenses method, because it may give the higher amount of deduction. Moving to problem number 7. Okay, for problem 7, we have Art is a self-employed installer of home entertainment system, and he drives his car frequently to installment locations. Art drove his car 15,000 miles for business purpose and 20,000 mile in total, which is mainly we have 5,000 mile for personal use. His actual expenses, including depreciation for operating the auto, are 10,000 since he had to have the car repaired several times. Art has always used the actual method in the past. How much is Art deductible auto expenses? So because Art is mainly using the actual method, so we have to use now the actual method. Okay, so based on this information, we need to work out the actual deduction for this problem 7. So the actual expenses is 10,000. Okay, and this mainly need to be multiplied by the business percentage. Business percentage here will be calculated here based on how many miles used in the business and how many miles, the total miles. So we have 15,000. This mainly business related, and this will be over the total miles, which is 20,000. So this will be the business related mileage. Okay, and based on this information, so we have now the actual expenses. And the actual expenses is 7,500. Okay, and since Art has always used the actual cost method, he must use the actual method this year. So this mainly means that Art must use the actual method this year, because he used to use it before. And remember here the rules. Okay, if it choose actual method, cannot change to standard method. So this mainly the rule for this specific issue here. Moving to problem number 8. Martha is a self-employed tax accountant. Okay. And who drive her car to visit client on a regular basis. She drives her car 4,000 miles for business and 10,000 for commuting and other personal use. Assuming Martha uses a standard mileage method, how much is her auto expense for the year? Okay. Where in her tax return should Martha claim this deduction? Okay, so we're starting with the first part, which is calculating the transportation cost based on standard mileage method. So she drive for business 4,000 miles. Okay, and remember the rules for the standard method. Here we may be using a rate of 0.535. So this is the rate that we use for business. So this is problem 8. So we have 4,000 miles. This may be business related. It will be multiplied by the standard rate, which is 535. So this will work out the transportation cost for Martha. So which is 2,140. So this is the first part of this question. And where in her tax return should Martha claim this deduction? Okay, so this deduction is should be claimed on Schedule C. So remember here on Schedule C, so we have this section, part IV, about information related to the vehicle. So, and this part is the part that the taxpayer need to give information about the use of the vehicle. And once we the taxpayer here got the information about the vehicle, okay, so this need to be included here in section or part, the second part, which is about car and truck expenses. So, and this is mainly this is the one line, and this is the detail here about the use of the vehicle or the car. Okay. So we'll write down here. So this information need to be deducted. So this expenses, this expense should be deducted on Schedule C. Okay, and this is mainly the information about transportation cost